welcome. Now it is a wee bit warm in the room, and considering the awful rain this morning. Thank you so much for coming to this event. MB Associates are Chamber patron members, and we've had a number of conversations over the last 18 months because they are really kind of community focused and actually want to work with the businesses, with a lot of our chamber members and beyond. So this is the first kind of joint event that we've done, and I think there will be hopefully many others which we can do as well, because the housing sector, the mortgages, a lot of the financial planning, other kind of commercial planning, there's a lot of information there, and as several of you already said, we just don't even know where to start. So I'm delighted that we've got Monica and her team here. They win so many awards per year, it's ridiculous. Virtually every 3 months, if you're on LinkedIn, you'll see Monica here going up, and here's another one, here's another one. So these guys really know their stuff. So the advantage for you being here, and I appreciate you taking a lot of time to come here, is you're going to hear very experienced, qualified advice, and then you'll be able to have some questions and answers, either sort of in this capacity or maybe on a one-to-one. So I'll leave this now over to Les and to Monica and the rest of the team, but thank you again for coming. I appreciate that a lot. Thank you very much.
Thank you.
Good morning, everyone.
Good morning.
How are we doing?
Very well.
Thanks for waiting the storm. We know it's not very nice out there, but if it makes you feel any better about your journey, I started mine in Dorset this morning. So yeah, it was, and I was here for 8:40. It actually wasn't as bad as it could have been, and for some people it wasn't a great morning because there was a few accidents on the way. So thank you all for braving the storm and coming and seeing us. This is the first one of these that we've done in this format, so hopefully it works well. Hopefully you'll take something away. Whenever you do a presentation, and it's, by the way, about 40 minutes, so hopefully that's in line with what you're expecting. There will be a Q&A at the end, but because there's just 10 of you, 11 of you, I think just like, if you have a question whilst we're going through these slides, please just jump in, all right? It'll make it far more interesting for you and for everybody else, and if you have a question, it's likely that somebody else has the same question. So we'll get it answered right there and then. But there will be time for a Q&A afterwards. Freebies on the tables. First of all, obviously some ways to get hold of us, some flyers and some leaflets, but also a book called Rewritten, which has absolutely nothing to do with financial services or mortgages, but it is written by a good friend of mine who kindly did us a deal on his book, and it is a fab book. It's nothing to do with finances, as I say, but it is to do with having a slightly better, healthier, happier life. And it isn't all mumbo jumbo. The guy who wrote it is the most highly qualified person in financial services in the UK. He does this for a living in front of hundreds of people, and he's studied psychology for 30 years, more specifically actually positive psychology. So it's a nice, easy read. If you read the reviews on it, they're really fab. And actually, I don't read many books. Podcasts are really my thing, but that's one of the few that I have read and have thoroughly enjoyed. So it's a little something to take away, nothing to do with mortgages, but hopefully if you have a little read, maybe one or two things in your life will get better. Okay, so a little bit about the team that we have here today. First of all, I'm Les, I'm the Sales and Ops Director. I have been in financial services for 28 years, and for a lot of that time I was a financial advisor. So I ran my own practice, not quite as big and successful as Monica's, but I ran my own little practice down in Dorset. And then over the last 10 years, I've worked for lenders. So spent a lot of time actually designing products that were suitable for people like you to maybe take out as mortgages, and specifically in the later life specialist world. We've also got Monica here, who's obviously our business owner, our CEO, managing director. She's the everything, the person that started this, and Monica will tell her more about herself. And we've also got the team here. We've got Chris. We're very unusual for a smaller size business in that we have somebody who's full-time marketing for us. So that's really, really important in this day and age, and she guides us all with our socials and everything else. And we've got Nigel, who I think most of you know because he comes to. Does everybody not know Nigel? Nigel has many years of experience, many years of experience in all sorts of things. But he's going to do a lot of business development work for us because we need to do more of this. Although we're a busy business, I've been brought in to grow it. So as part of that growth, can't just do that. We can't do the day job and grow business, do all these events and things. So Nigel's very able and very happy to help us with that. And we've got James, who's our commercial specialist. So I'll come to why I joined MB Associates in a little bit, but talking about the word specialist is one of those reasons. So we've been around for a long time. Monica's been running this business for over 25 years. We get lots of 5-star reviews, which is lovely. We're always very thankful for them, but it isn't just our advisors that get the 5-star reviews. Why this business is different, I'll come to on the second slide, but we get a lot of 5-star reviews that mention all of our team. So if James is placing a mortgage for somebody somewhere, you know, it's his admin team that are behind that get just as much praise and kudos as he does. We won the FIFO Service Award for the last 4 years running, which is a phenomenal achievement. And basically our job is to save you time, money and stress if you're ever involved in the mortgage process. So why did I come here? So I've spent 10 years in corporate world, and I loved every day of it really, or most days of it. But I spent a lot of time training financial advisors how to run their practice. And one of the things I used to say is if you're going to build a practice, even if you're just a sole trader, find a small network, and you guys will network, you're part of the Chamber of Commerce, so you're already doing this. But find a small network of people that created practice effectively where you refer to each other. So that if you've got a major thing happening in life, right? So if you're in the back of an ambulance because you've had a very bad day and you've been hit by a bus, do you want your GP waiting at the end of that journey, or do you want the heart surgeon, the spinal surgeon, and that to work together as a team? And this is what I've been talking to financial advisors about. You cannot know everything about everything. So surround yourself with specialists. It's the same thing with health, and it's the same thing in law firms. If you go through the front door of a law firm and you speak to the receptionist and they say, how can I help you? Right, I've been nicked by the police for stealing from a shop. Right, you need the criminal lawyer. Okay, I'm going through a divorce. You need the family lawyer. Actually, I need to buy a will. You need the estates and planning person. So basically, this practice is set up in the same way as I've been teaching people to do it for years, and that was the massive attraction for coming to this business. We are whole of market, but in addition to being whole of market, we also have access to some exclusive products. We're part of the Mortgage Advice Network, Mortgage Advice Bureau network, and they have specific products that are only available to members of that network. So it's an overarching business that's above us. And more than anything, it's a business that creates strategies. We're going to talk about strategies this morning. Anybody can sell you a 2-year or 5-year fixed rate. Anybody can do that. To be honest, in the next year or two, AI will do that for you. But it's not going to create a strategy that helps you to repay your mortgage as quickly as possible. So we'll give you a little bit of a market update. It's been a weird year, hasn't it, really? You've only got to turn the news on. The last time I rolled over in the morning expecting exciting news, it was COVID, right? And in the last 12 months, I wake up in the morning, go on BBC News and wonder what the hell's gone on a few thousand miles away across the water. But actually, in terms of the mortgage market and housing market, it's a fairly stable kind of environment. Now here we have seen some volatility close to here, Surrey, London. We've seen a little bit of volatility depending on your postcode as to whether house prices have gone up or down. But there has been a very stable year for house prices across the UK, and there have been a lot of positive signs as well. First-time buyers had a super strong year next year. I don't want to steal Nigel's thunder, but he's got some information, some stats on just how strong a year it was for first-time buyers. And so, whilst the growth has been a little bit slower than we might have predicted at the start of 2025, there was still steady triplet growth. Of course, that did slow down towards the back end of last year. In mortgage world, we always expect tumbleweeds in December. Everybody just goes, right, there's no point. It's either a massive rush to get a completion before Christmas, because somebody wants to complete and get in their property before Christmas. Other than that, new customers just disappear. This year it happened a month early because everybody was thinking, what the hell's going to happen in this budget? So actually, November and December were quiet, but the rest of the year, all things being equal, was fairly buoyant. And one of the things that drove that was the first-time buyers. Another thing that drove it was interest rate going down, okay? Well, what happens is, interest rates drop a bit and it gets people in an excited frenzy, right? So everybody thinks, oh my God, mortgages are going to get cheaper, they're going to get cheaper. Yes and no. The Bank of England base rate going down is a good thing, all right? It's a good thing for us, but we require inflation to be lower in order for that to happen. But the thing about those rates is if I'm an actuary, and by the way, I've just spent 10 years in lender world, I know how this works. I'm pricing 2 years, 5 years, or potentially even further down the road. So your deal, just because the Bank of England drops a rate in February or it drops in March or April, it doesn't make any difference to the mortgage deal. It's just pointless hanging on, because the actuaries, the very clever people behind it, have already priced that in. They're buying money at one rate, thinking they're going to secure that money and lend it to you at another rate. They'll make a little profit on that, and basically that's all priced in. So all of these, the problem that we have as mortgage brokers or estate agents or lawyers that want to write conveyancing business is that the market stalls waiting for these lower rates to arrive, but in actual fact they're already here. The thing that will drive rates down this year isn't the interest rate, the Bank of England base rate, which probably will drop by 1 or 2 quarters again, so we'll drop by 25 or 50 pips. It's competitiveness in the market. How much money is there in the banks that they want to lend? And if your target has just gone from 500 million to 750 million, you've got to find a way to get that money out there. And what lenders have done is they've started to find niches, which is fantastic for you guys, for anybody. It's fantastic for the whole country. Because when lenders look for specialist areas of lending, it opens the market up. So instead of 4.5 times income, they'll stretch to 5 and then to 6. And so that means that more people are able to afford those mortgages. They'll put their rates down, which means that people can genuinely afford the mortgages and not just on those LTIs, as we call it, but basically with the amount of money that you earn to the amount of money that you can borrow. There were a few negatives last year. Obviously, unemployment rose last year, and another negative might be that actually adverse credit went up last year. But interestingly, the biggest growth area for adverse credit, if you can call it a growth area, was actually people earning households with more than 100k a year income. They got used to a certain level of standard of living. They got used to changing the car every 3 years. They got used to a holiday in the Caribbean every year, and they maintained that lifestyle whilst the cost of living for everything else went up. Then it goes onto the credit cards, then you've got the debt. And that's where working with a financial advisor can be really, really useful, because you've got that strategy being in there, and maybe a financial advisor or mortgage review will actually highlight some of the areas where you may have a problem going forward, even if you don't identify it today. Lots of people stick their heads in the sand when it comes to these things. The outlook for 2026, let's get some economists in. We put 2 economists in this room. We will have at least 3 or 4 views on what's going to happen in the market this year. It's very difficult to know with the socio-economic situation and also the geopolitical situation. Anything could happen, right? But what all of the economists are suggesting is that there is a buoyant market. So everything, when it comes to house prices or anything in life, supply and demand is what creates the price. And at the moment what we're seeing is a lot of first-time buyers in the market, but equally we're also seeing potentially 40% of buy-to-let owners, landlords, thinking about potentially selling this year. We've also seen a very, very buoyant market from an estate agent's point of view, putting houses on the market. So that at the moment, I would say, me personally, it goes against what economists are saying, is supply and demand says if you've got loads of houses for sale and a good buying market, but not, not as strong as it might otherwise be, then potentially there could be a small short-term blip to house prices, which then by the end of the year should increase. But what we are looking to counter that is lower interest rates, easier borrowing, making it easier for first-time buyers. And more than that, the lenders are actually taking a risk here, taking a gamble. There's a 100% mortgage available, there's 95% mortgage available, there's 6 times income available. So there's lots of things available to help first-time buyers get their foot on the ladder. And one of the things we'll look at later is actually the gifts from bank and mum and dad, effectively, because the figures are outstanding. So, so that's basically what we think is going to happen this year, a very steady market, short of something catastrophic happening in America. All right, that's basically where we are. I'm going to hand you over to Monica to talk about the business and how she set it up, why she set it up, and what really the culture of the business is.
Thank you very much, Liz.
It's down on
Good morning, everyone, or afternoon, everyone. Thank you, Les, for that. That's really informative, just to tell you what is happening. I'll just quickly start by saying that I started my career many years ago in the wealth field. So I was a wealth advisor, advising in investments, pensions, and I relocated, not miles and miles, but I was working in Sussex in an office. And I relocated and took on some offices as my business was clearly growing. And I became known as a mortgage guru. I get called Monica Money, Monica Mortgage. You wouldn't believe the sort of names that I get from my clients, but it became a real passion of mine to start working with clients. And it became so much of a passion that I wanted to make sure that every single client that comes through our door pays the lowest amount of interest for the lifetime of their mortgage. I'm not talking about 1 year, 2 year, I'm talking about thoroughly educating everybody to come into us, sit down with an advisor, whether it be, we know we can do Teams, telephone work, but it's really about educating people, because enough people, in my opinion, don't understand that they should make a little overpayment. Do they know the impact that that makes to interest? Do you know how much that can take off the term? So the reason why we're growing and the reason why we do what we do, and we've got great advisors and great staff in behind all of our advisors, is because we do what people should always used to do when you've got the pension man come to your front door and collect the money to put in the pension. It is changing. AI is going to take a lot of pushing a button very easy. But this is about advice. We are living in a world of a country, a world full of a cost of living crisis. So why on earth would you not take real control of your own finances and understand what interest is? You don't see a very poor bank, and you don't see a poor credit card company, and you hear Martin Lewis talk about pay back the highest amount of interest first. That's what we do. We really do empower our clients, and we work with them over the long term. We're not interested in seeing them as a one-hit wonder, a transactional deal. We want to make sure that they pay seriously. It can amount to hundreds of thousands of pounds by paying 0.3% difference. We don't borrow 20 grand anymore. We borrow 100, 150, 200. We work with our clients. We tell them up front, we're here for the lifetime of your mortgage. We get lots of referrals for first-time buyers because we teach you about interest. We tell you, we show you. Do you know how many people think you have to take a 25-year term, or a 30-year term, or a 35-year term? But actually, what happens if you've got the budget, because we will work with you on your budget, if you've got the budget to actually be able to afford 1 year less or 2 year less, that is a significant amount of money back in your pocket as opposed to a bank. So that's why we're growing, and that's what we do. I'm going to talk a little bit about preparation. What should you be doing if you are thinking of remortgaging, purchasing, doing an investment property? Should you take if you're looking at investment properties, should you be going into the limited company field? So as Les said, we specialise. We have specialist individuals that can look after you that. Each and every one of those different loans, we've got someone that can look after you. But if you are looking, it's really important to get your finances in order. You know, a bank will do a credit search on whether you're doing a personal loan, a mortgage, car finance or a credit card. Literally, a bank will do a credit search. And a lot of people don't understand that actually built into that credit search is something called a debt to income ratio. So it basically means, what is your salary, how much debt have you got, and you've heard the saying, a computer says no. So if you work with the broker, get your finances in order before. If you're looking at moving, you really need to be doing it 8 months before. Look at your situation. What are you paying on credit cards? Have you got any loans or car finance? Have you got any missed payments? It's really important. All these things are built in to what a lender will do. And I think Les touched on, we have gone through a period of change. We've got a bank base at 375 from 5.25. That is great news. Anyone renting in the room, rentals are through the roof. In fact, James and I were talking about it en route here today. So if you can buy, and tell all your colleagues, talk to us, because there's a real misconception that you need to have £50,000–60,000 to buy. You don't. In fact, this misconception has been around since COVID. You only need a 5% deposit. And by the way, that can still, even though the rate will be slightly higher the less you put down, but that will possibly be less than your rent. So, Nigel's going to cover some of this later, but I just wanted to say, be prepared, talk to your advisors early, don't leave it if you're thinking of purchasing. And obviously, if you're self-employed, a lot of misconception around everywhere regarding can we get a mortgage if we're self-employed? The answer is yes, you can, but again, work with your advisor, because as a self-employed person, and I know we've got some accountants in the room, the banks work on your past, whereas if you're employed, it's your current pay and your PAYE pay slip. If you're employed, it's the history of what you have earned. Many people say to us, oh, but next year, a bank is not going to lend on next year's figures. So preparation is really my message. And also making sure that nobody is paying too much. Set yourself a realistic budget. There's not just mortgage payments. We know that too well. It doesn't matter whether you rent, if you buy, or indeed you've paid a mortgage off. You still have huge amounts of monthly outgoings. Our utilities are high, our food is costing more, everything's costing more. So the point here is budget. I just want to ask the accountant I was speaking to. You were saying about self-employed, and obviously around the word self-employed and what the revenue, what the real summary is, because there's a real thing going through the self-employed business on digital. And you said to me, realistically, what it means is the revenue want you to have everything, all your self-employed, digital now.
Digital records,
Yes.
as opposed to manual records. if you could imagine a ledger where it's just the list.
Yeah.
With a digital record, you can drill down into that and see. I mean, just to add to that, there's also invoicing that's going to be digital as well. So as you can see, the building blocks are in place. So you've got the digital ledger, then the digital invoice comes in, so you don't need to trace someone to see what they've spent it on because it's all there.
Yeah. So that should make lending should be a little bit easier when that comes in, because there's no question in the future that's going to change stuff. There's no question that whereas you used to be able to give your accountant a plastic bag full of receipts, those days are going to change. They will have to be a lot more professionally done than that. So I won't take up any more time. I'm going to come back and talk about some bits about business, but I'm going to let Nigel continue with the mortgage theme.
Thank you. Hi everybody. Thank you. I actually have had a slightly different route to financial services than Monica and Les. So I've had a 40-year career in sales and consultancy in the fashion business, and I transitioned into financial services just under 3 years ago now, following a very expensive divorce from my second wife, which made me have to look about how was I going to make some money. And actually, having now been in this industry for a while, I wish I would have done this 10 years ago, because it is incredibly rewarding. And I hadn't realised actually, you know, a mortgage is, you know, not a kind of perfunctory purchase. It's actually working, as Monica said, it's about working with your clients, getting to know them, getting to understand what their goals and aspirations are, and building with them a plan to, you know, make them understand their finances. So I'm going to talk to you a bit more about the process. So the process is definitely get the documents ready before you start a conversation with a broker. And those documents principally are proof of ID, so passport or driving license, proof of residence. You'll need a utility bill or a council tax bill. You'll need 3 months pay slips if you are employed, and 3 months bank statements if you, either your personal joint accounts. Again, the broker will need to see that, and lenders will also need to see that information. Sorry, I'm on the wrong slide. Okay. Definitely avoid overspending in the last 3 months, because as you're going to give your bank statements to the lender, the last thing they want to see is that you're constantly going into overdraft, and that will show that you are a bit more of a risky proposition. So try and avoid overspending in your last 3 months. Find out from a broker what you can afford. So this is really important to actually have in mind a budget. Lots of first-time buyers that I speak to who are renting, you know, that's their kind of benchmark. They're paying £1,500 a month as a rental, and they say, well, I'd like £1,500 to be the mortgage. And as Monica said, invariably, the cost of getting the mortgage for that property that you're renting is going to be less. In fact, in one case, it was actually half of what she was paying for rent was actually the mortgage, so a massive saving. The process is about sitting with that broker. Generally, we do what's called a fact find. It takes about 30 minutes. We sit with you, we go through your income and your expenditure, and also, you know, where your short-term and long-term goals are, and we'll put together a plan. It's no point taking out a mortgage that's so high that actually you can't afford to go out to eat or go down to the pub. So that's about affordability, understanding what you can afford without overstretching yourself too much. At that point, we would be able to get what's called an agreement in principle or decision in principle, the DIP as it's affectionately known in our industry. You don't actually have to have a property to get a decision in principle. So you can work with one of us, with a broker, and actually once we've gone through that fact find, we can actually get you a decision in principle for a property. And I can tell you, actually our office in Kingston is next to an estate agent. They really like a potential buyer to come to them with a decision in principle, because that means that you can move quick and you're a better proposition for their sellers. So it's a good idea to definitely have that in place. Oh, my mouth's really dry. Sorry.
Plenty of water there now, Jim.
Thank you. Okay. Nope, I pushed the wrong button. It's down. Okay, so first time buyers. So here we go, Kimberly. This is for you. And any other first time buyers that may be in the audience. Okay, so some lenders will lend up to 95%, as Monica said. The myth of needing 10% or more is not exactly true. However, if you've only got a 5% deposit, the rates will be slightly higher in terms of borrowing. You can borrow up to 5.5 times your joint household income. So if you go where you're thinking about buying a property, you've got a joint income of 100,000, roughly speaking, you can get a mortgage of around 500 or 550,000. Now, whether you can actually afford that or not is another story, and that's something that, again, sitting with a broker, you'll go through income, expenditure, what you're planning. You know, you might want to be going on holiday, you know, to the Bahamas or whatever, and, you know, you don't want to overstretch yourself, so maybe 5.5 is a little over-ambitious. Lenders will go to, as Monica said, to self-employed as well as employed buyers. And the gifted deposits, that is something that we're seeing more and more. The bank of mum and dad. And actually, as an interesting statistic that I found out the other day, something like 1,500 first-time buyers a day are getting help from the bank of mum and dad. 1,500 a day. And the average gift is about 50,000. So if you're a parent, better get ready to help out your kids. In fact, I had a very funny phone call from a client a few months ago who said to me, "Look, Nigel, I've got to get my 35-year-old son out of the house. I'm desperate. So I want to remortgage my house." Actually, was going to do an equity release so he can get out. I'm sick of him living here. So, you know, that's the kind of the ideal situation where people are raising money. A lot of our generation, or my generation, we're sitting on a lot of equity in our properties, and you know, it's not that difficult to extract money from that property. However, and this is something to be aware of, as far as a gifted deposit is concerned, they're really, really cautious about potential money laundering. So, if you are getting a gift from the bank of mum and dad, you will need, or they will need, to provide a letter stating that they waive any right to the property, that it is a gift and it's not repayable. They also must prove their ID, and more importantly, they must prove where those funds came from. And in fact, when I was selling my former matrimonial home, we had a Chinese buyer who had £100,000 in his bank account that he claimed was from the sale of a property in France, but he couldn't prove it. And his own solicitor actually said, "I'm not going to sign this off." So actually that deal went south, unfortunately, because he just didn't, you know, who knows where that money came from. And that is, again, something that lenders and solicitors particularly, and Julian, you'll know this, that you have to make sure that the client's funds for deposits are legitimate. Okay, remortgaging. So, quite an interesting statistic. About 1.8 million homes are due to be remortgaged this year. So that means there's a lot of people coming off their 5-year fixed rates, some of which are below 2%. So they're in for a bit of a shock when they come to remortgage, although obviously not as big a shock as they would have done 18 months ago. So if you had a 5-year fixed, you've got to budget for not just, well, just under doubling, going from say sub 2% to high 3%. If you took out a mortgage when the rates were very high and you went for a 2-year fix on the kind of proposition that rates would eventually come down, in fact, your remortgage will cost you less, because today rates are sitting somewhere between 375 and 475, again, depending on the loan to value. So plan early, talk to a broker, make sure you understand what it is that you can afford and what you're able to source in the market. As Monica said, look at different mortgage terms. You don't have to have a 25-year or 30-year term. You should be thinking about potentially overpaying during that term of the mortgage, so you can reduce the amount of interest. And certainly, as far as remortgaging, you can fix a rate 6 months before your current mortgage expires. So you can lock in a rate now, and if the rates come down, what we do as a service to our clients is that we'll monitor those rates, and if there is a fall, we'll switch you to a better rate prior to the completion of your mortgage. So at least you know before the end of your mortgage exactly what it is likely to cost you going forward. And the last slide for me is about self-employed. So yes, you can, and as Monica said, it is a retrospective calculation, so you definitely need tax year overviews and tax calculations, self-assessment, your forms that you've submitted for the last 2 years. Bearing in mind those are based on April in any particular year, so now we're getting closer to April. It's good if you're thinking about a mortgage, get your self-assessment in as quick as possible. Certainly if you are a director of a company, lenders again will look at retained profits, look at profit before tax, depending on the shareholding in the company, so you can use that sort of income as well to increase. Lots of directors, as is it David?
Mark,
sorry. Sorry, beg your pardon.
That's okay.
You know, you'll know yourself, lots of directors of limited companies pay themselves, you know, 12,570, and then they want to get a mortgage for 500,000, and you know, there's not a hope in hell unless they've obviously got good profits before tax every year. So those are all the things that working with a broker that we can help you with. And on that point, I think I'm going to hand you back to Liz.
Yes.
I'm sorry.
Thank you for listening.
Right, guys. Okay, so specialist lending. First of all, we've got James in the room, who is our specialist commercial broker. And as well as mortgages, basically, if you've got a loan secured against anything, we can help you with it. So asset finance, semi-commercial, trade business finance. Doesn't matter what it is, if it's a loan secured against something, we can help you with that. There are other forms of specialist lending, and this really, really helps, particularly when we talk about the changes in the way that this country operates now from a socio-economic point of view. When you go through a divorce, as Nigel has said he's done twice, and I'm also in that camp, it's expensive, I can tell you that. And the thing about that is, when you do go through the separation, it's a tough, stressful time. And what you're going to do, you're going to do the 2 most stressful things that you can possibly do at the same time. And you just got to hope that your family stay fit, well, and healthy during that time as well. Otherwise, you do 3. But basically, sales of a jointly owned home can act as a deposit on your new property, which is fantastic. But quite often, people get help from parents, as I did. So effectively what happened was my dad released some capital against his home in order to give me a deposit to go out and get back on the property ladder. Otherwise I've been stuck in a rental trap for the last 10 years. So it's all about using family wealth that can help you with a difficult situation. And that brings us on to mortgages over 50. Now, if I was on Mastermind tomorrow and I had a chosen subject, it would be this. All right, I've immersed myself in over 50s lending for a large proportion of the last 28 years. It is possible to get a mortgage over the age of 50, it's possible to get a mortgage over the age of 60. Anybody want to guess the age of the person that I gave a 40-year repayment mortgage to last year? So this is a 40-year repayment mortgage. How old do we think that person was that we gave as a lender a mortgage to?
72.
Up.
No.
Higher.
Right. It's actually 80. 80-year-old lady.
My mum's just remortgaged at 87.
Amazing. And what sort of mortgage does she have?
I've no idea, she's just done it to pull some equity out to do some repairs that briefly is doing.
Right, so she might have done equity release rather than a normal mortgage.
No, she's definitely done it. I know how my mum's done it. She's remortgaged part of the house because her mortgage was paid off, so she's just stuck another mortgage back on it. But she's 87.
Yeah, and there are 4 types of mortgage that she could have potentially have taken. So mortgages for over 50s, 60s, 70s is not a problem. Number one, that's all you need to take away from this slide. And if you wanted to go to a brokerage firm with an expert in it, even though I won't be giving the advice, that would be me. We've also got a guy who's just been nominated for the top 3 advisors in the UK for equity release advice, and he's part of our practice. Again, coming back to that specialism. So there are in actual fact 4 types of mortgages. You can get a standard repayment mortgage, like the lady did, was 80 years old, we gave a 40-year repayment mortgage to. You can do interest only, which is fine. Interest only, like the good old days, which is just, I want a mortgage at the age of 65 to the age of 75, when I'll probably downsize, I just need that to be interest only. Or we can do something called a REO mortgage, retirement interest only. This is an interest only mortgage, but there is no fixed term other than you passing from this mortal coil. So basically that is a mortgage for the rest of your life. And so as long as you keep paying the interest, nobody can come and ask for the money back. And then the 4th type is a lifetime mortgage. Now, lifetime mortgages, what used to be equity release, have evolved dramatically over the last 10, 15 years. I can tell you now, having worked in lender world, A-list celebrities, and I mean global A-list celebrities, have used a lifetime mortgage to release capital from their property to avoid inheritance tax and give down to their kids. I can tell you though that I lent over £1 million to a prince and princess in Chelsea. I can't tell you which ones, right? This is not a dangerous product. This is not a poor value product anymore. The thing about lifetime mortgages, you know what the interest rate is going to be forever because it's fixed. And you can choose to pay the interest, you can pay more than the interest, or you can pay no interest. And 1 month you can pay interest, and 1 month you don't have to. It's a wonderful, wonderful product that the rich and wealthy are using to get even richer and wealthier. Right? One lady, for example, Hayling Island, 2007, 2008, took out £200,000 against an £800,000 property at that time, gave them £200,000, 50 grand each to each of her grandchildren. It doesn't take a rocket scientist to work out that whilst that £200,000 is now at 400,000 because she didn't pay any interest on it, the reality is it's only actually cost her estate 60% of that. It's cost her estate 120 grand. Those properties that the grandchildren bought doubled in value. They turned 600 into 1.2, at least, right? This is how the rich get richer. They use the capital that they've got and they spent their lifetimes building up. And so, you know, I would say when it comes to older borrowers, you need to create a strategy. Something else that we have in our business that nobody else has, and that's because we built it, is a strategy tool. It is the only tool in the UK that combines property wealth, mortgages, investment and pension wealth, all combined in one place. So using the calculator that we've built, you can see the value of your property today, you can make an assumption around how much that property will go up by, you can see how much you put into your pension and how much that might go up by, you can see your mortgage and how much that will go down by. The really fun bit is finding out when you're going to be a millionaire on paper, all right, because it puts all of those things together. But it's a phenomenal tool, it creates strategies, and we're the only people that got it because we built it. And that's it really, from a later life perspective. If any of that is of any interest in, and you've got any questions on the Q&A, grill me, okay? I love that. In the meantime, Monica's going to show you and just talk to you about the importance of protecting those hard-earned assets once you do have a mortgage on it.
Thank you, Liz. Lots of really good stuff there, and it's questions we get on a daily basis. But I just want to quickly talk about, because we're obviously at the Kingston Chamber of Commerce, so we are thinking there probably are some business people in the room. So I just want to talk about, because this is something I see a lot, and I see everybody so busy in their businesses, running their businesses, looking after their businesses, but actually what they're not doing is saying what happens in the event of a partner or a director gets ill or worse than that, dies. And I just want to cover, if I can work this.
Arrows down.
I just want to cover things to think about. There's just some things to think about. If you've got people that are, or you're living with people, or people that run a business, to just really say, have you thought about what happens to your business in the event of, if it's a director, or if you've got a key person. So many businesses have people in their businesses that are really, really very important. Without that person in the business, I have one in my business who's worked with me for, she says she would have got a lot less for murder, but she's worked for me she's worked with me rather for 21, 22 years. Now, if something happened to this girl, would it have a financial impact on my business? The answer is yes, it probably would. So there are some things for your accountants, for your clients to think about. Key person protection, protect your key people in the business. Director share protection, what happens, and I've seen this, I've seen an incredible amount of mess when one director dies, or one director gets ill and leaves another director in the business. Have you made provision for this in your memorandum and your articles of association? Because not every business has the funds to be able to purchase the deceased person's shares. So it's really important to know there is something called director share protection. I don't want to cover it all now, we can cover it. And the other big important thing I want to say is, if you're paying for life assurance and you have a business in a limited company, and this is not on, it pays on death, but it does, the funds do not go to the company. So you can pay for, you can have a fully tax deductible life assurance policy paid for by the company in trust for your loved ones. It does not go to the company, it goes to yours. But if you're paying life assurance, or somebody in a limited company who's paying life assurance from their personal bank account, tell them, why don't you put it through the business, get tax relief. It's not a benefit in kind, it doesn't need to go on a P11D, but it will save you a lot of money. We've covered a lot of things today. I just wanted to get that part in because businesses don't always think about, they're so busy running the business, they're so busy acting in the business, they never think about it. And believe you me, I've seen businesses that have taken some policies out, but because they weren't written correctly, they went to the wrong person at the wrong time, and I've seen 8 and 9 years of law battles. So it's important just to seek advice. Any questions, we are happy to cover. We've covered a lot, but we wanted to get across lots of different areas because lending is so different, which is why we've got specialists. And so whether you're a first-time buyer looking to invest later life, for whatever reason, we can help. It is complex. So I would like to thank all of my team here for sharing some really valuable stuff today, and we're happy to answer any questions.